Hi everyone, welcome to the session. In this session, I'll be discussing about standard costing and variance analysis. Okay, so under this, I'll be discussing about different types of variances. So like such as direct material variances, direct labor variances, then we have variable production overhead variances, then fixed production overheads, and sales variances. Okay, so basically, we have different types of variances that we need to calculate under standard costing and variance analysis. So we have direct material variances. Under this, we have to calculate two types of variances, basically the price and the usage variances. Okay, and under direct labor, we have again two types of variances, basically rate and efficiency variances. Then we have variable production overheads. So under this also we have two types of variances, basically the expenditure variance and efficiency variance. Under fixed production overhead also we have two types of variances, basically expenditure and volume variance. We have expenditure and volume variance. And also this volume variance can be subdivided into further two types of variances, basically the volume efficiency and volume capacity variances. And finally, we have sales variances. So under sales variances also we have to calculate two types of variances, basically price variance and volume variance. Okay, so these are the types of variances that we are going to look at under this standard costing and variance analysis. Okay, so let's first and foremost let's move on to the first one, the direct material variance. Okay, so now in order to understand this concept, let's go through a question. Okay, so I have selected one question. So through this question we'll try to understand the concept. Now product P has a standard direct material cost as follows. Okay, so this is the standard direct material cost. Okay, so basically this is our plan. This is our budget. What is our plan? We were planning to use material M 10 kg. Uh, the cost per kg is 10 per dollar, $10 per kg. Okay, the per unit cost is $100. Okay, to produce one unit you need 10 kg and the cost of 1 kg is $10. So therefore we have to incur $100 to produce one unit. So this is our plan. During a period 1000 units of P 1000 units of P were manufactured. So this is our actual production. Okay, using 11,700 kg of material M. So this is our actual consumption. Actually, we consume to produce 1000 units 11,700 kg, which cost $98,600. Okay, so actually we incurred 98,600. Okay, now basically I told you the total direct material variance or direct material cost variance consists of two types of variances. What are those? Price and usage variances. So let's look at this. So direct material cost variance or the total variance consists of price variance and usage variance. The price variance means we compare the prices, the standard price and the actual price on the actual consumption. This is very important, okay? And the usage variance means the actual consumption we have to compare with our standard consumption or the planned consumption or planned usage, and that difference has to be multiplied by the standard cost of a material. So this is what we need to identify. So the direct material cost variance, basically, how do you calculate? Okay, so this direct material cost variance basically means you just compare the actual cost incurred, okay, actual cost incurred 98,600 on this 1000 unit with the budget. How much is the budget per unit? 100. Okay, so this is a total variance. Okay, so basically you compare the budget and the actual. Okay, to produce 1000 units, to produce 1000 units, you plan per unit $100. So therefore 100,000. So 1000 units should have cost, okay, 100,000. So basically 1000 units times $100. Okay, that should have cost, so 100,000. How much did it cost? It cost 98,600. So therefore we actually incurred a less amount than the plan. So therefore, the variance is a favorable variance of 1,400. So this is our variance, the total variance. So we planned 100,000, but we incurred 98,600. Okay. Now, the total variance consists of two components. One is the price, and the other one is the usage. The direct material price variance, what does it mean? Now here direct material price variance, we need to calculate on the actual usage of material. Okay, just compare how much should I have incurred to produce actual uh, material requirement. So actually you consume 11,700 kg. Okay, for that you incurred 98,600. Provided if you had used the standard rate, so standard or the planned cost was 10 per kg, how much you should have incurred on this 11,700? So on 11,700 kg of material M should have cost 11,700 times 10. This was our plan, the standard cost. So we should have incurred 117,000 on the actual material consumed. However, we incurred only 98,600. Okay, so therefore we have a favorable variance of 18,400. Is that clear? So we have a favorable variance of 18,400. Now let's move on to the usage variance. Now here the usage variance means we have to compare the standard consumption, standard usage, and the actual usage times the standard rate. So the standard usage, how much? We need 10 kg per unit. We produced 1000. So therefore, we should have used how much? 10,000, right? 10,000 kg. So this should be 10,000 kg. So 1000 units should have used 10,000 kg to produce 1000 units, because we need per unit we need 10 kg. So how much did we use? We used 11,700 kg to produce 1000. So 11,700 kg. So therefore, we had a usage variance of 1,700 times our planned cost was 10. So therefore, we will have a usage variance, direct material usage variance of 17,000 adverse. Why? We were planning to use to produce 1000 units, 10,000 kg, whereas we used 11,700 more materials being used to produce 1000 units. So therefore, it's an adverse variance. Now, when you compare this 18,400 and favorable variance and 17,000 adverse variance, so favorable against adverse, you can see the difference. 18,400 minus 17,000 will be the total variance or the cost variance of 1,400. It's a favorable variance. So this is the basically, this is how you calculate the direct material price and the usage variance. Okay. Okay. So therefore, this direct material cost variance consists of direct material price variance and usage variance. Now let's move on to the next variance, direct labor variance. Okay. So under direct labor variance, as I previously explained you, we need to calculate two types of variance. Basically, it consists of two types of variances. There is another variance that we need to calculate provided you are given the information. So basically, we have to calculate direct labor variance, which consists of uh, rate variance and efficiency variance. Okay, and if you are given idle time hours, then probably we'll have to calculate the idle time variance as well. Okay, so but basically, since this is a basic introduction to standard costing and variance analysis, I'll be focusing on the main two variances, which is the rate variance and the efficiency variance. So let's move on to a question. So I will explain you through a question. Product P has a standard direct labor cost as follows. Okay, you are given the cost of the plan or the budget for this product P with regard to direct labor. Labor grade A requirement is 2 hours, $5 per hour. Per unit cost is $10. Okay, during a period, 1,500 units of P were made. How many units were produced? 1,500. And the direct labor cost of grade A labor was 17,500 for 3,080 hours of work. Okay, so let's analyze this question. Now, what is our plan to produce one unit? The plan is you need 2 hours to produce one unit, and the cost per hour is 5. So therefore, to produce one unit, your cost is 10 per dollar. $10 per unit. So how much being produced? 1,500 units. To produce 1,500 units, how much labor was used? 3,080 hours of labor hours, grade A labor hours were used. At which cost? 17,500. So therefore, the total, the direct labor cost variance, how do you calculate the total variance? Simply compare your budget and the actual to produce 1,500 units. Okay, so To produce 1500 units, you used 3080 hours at 17,500. So 17,500 was your actual cost incurred. How much you should have incurred to produce 1500? Per unit cost is $10 per unit. So therefore you should have incurred 15,000, right? So if you take the total variance, direct labor cost variance, you should have used, so direct labor cost variance, so 1500 should have cost 15,000, right? So 1500 units, and per unit cost is $10 here, $10, right? So how much did it cost? 17,500. So therefore, what is the cost variance or the total variance? This is the total variance, 2,500, and it's an adverse variance. Why? Your plan was to incur 15,000, but you actually incurred 17,500. Okay. Now this the 2,500 total variance consists of rate variance and efficiency variance. Okay. So first of all, we look at the rate variance. How do you calculate the direct labor rate variance? Basically, you need to compare, okay, the standard cost incurred on actual hours with actual cost. Okay. Now, actually, how many hours being used? 3080 hours were used to produce 1500 units. So basically, you used 3080 at 17,500. If you had used the plan cost, the plan cost was $5 per hour. If you had used $5 per hour to produce 3080, how much you should have spent? So which is 15,400. So to produce 3080 hours, you should have paid $5 per hour. However, it cost 17,500, right? We paid 17,500 on 3080 hours. So what is the total rate variance? 2,100 adverse variance, because we were planning to incur 15,400, we incurred 17,500. Okay, so this is the rate variance. Now let's move on to the efficiency variance. So basically, the efficiency variance compares the standard hours with actual hours. Okay, so how efficiently the hours being used, this is what we need to calculate here. Now we should have used, to produce this 1500, right, 2 hours. 2 hours is the requirement to produce 1 unit. On 1500, how much we should have used? Which is 2 hours time 1500, 3000, right? So 1500 units should take 3000 hours, right? But how many hours were used? It did take 3080 hours. So what is our variance? So 80 hours were used more than the budget. Okay, so therefore, at standard cost, the efficiency variance is 80, and we should have incurred $5 per hour on this 80 hours difference of efficiency. So the total direct labor efficiency variance is $400 $400. It's an adverse variance because we should have used 3000 hours, but we used 3080 hours. So therefore, it's inefficient. So therefore, it's an adverse variance. Okay, 400 adverse variance. So when you compare this 2100 plus this efficiency variance 400 adverse, the total should be 2500 adverse variance. Okay, so to calculate direct labor cost variance, that consists of the rate variance and efficiency variance. As I told you earlier, if you are given the idle time hours, the idle time hours should be deducted from the hours taken. Okay, then we need to calculate the efficiency variance, and idle time variance has to be added separately. For example, let's say the idle time hours is $100, sorry, 100 hours. You need to remove 100 hours and you need to calculate the efficiency on 2980. Then 100 hours has to be the idle time variance, which is 100 hours times uh, standard cost per hour 5. So that has to be taken separately. Okay. Anyway, I'll be discussing a question on this. So then you will have a better understanding on how to calculate the idle time variances. Okay. So now let's move on to the next variance, which is variable production overhead variance. Okay. Now, under variable production overhead variance, also we have to calculate basically two types of variances. One is the expenditure variance and efficiency variance. Okay, so let's go through a question so that we can understand the concept. The variable production overhead cost of product P is as follows. 2 hours at the rate of 1.5 per hour. 1 unit requires variable production overhead cost $3 per unit. Okay, so during a period, 400 units of P were made. The labor force worked 760 hours. The variable overhead cost was $1,230. Okay, so basically, if you analyze to produce 1 unit, the variable production overhead requires 2 hours at the rate of it absorb the cost at the rate of 1.5 per hour. So therefore, to produce 1 unit, you need $3. Okay. So during a period, 400 units were made, and they actually worked 760 hours at $1,230. They incurred $1,230. So basically, variable production overhead, as I told you, it consists of expenditure variance and efficiency variance. So the variable production overhead total variance, how do you calculate? Basically, like how we calculated direct material total variance and direct labor total variance. So likewise, you have to apply the same calculation, which is the difference between your planned overhead cost versus actually incurred overhead cost. So actually incurred 1,230 on 400 units, but you should have incurred per unit $3. Okay, so $3 times 400. How do you calculate that? Variable production overhead cost variance. So basically, on 400 units, you should have incurred 400 times 3, which is 1,200. But it cost 1,230. Okay, more than the budget, more than the planned cost. So therefore, there's an adverse variance of $30 on the variable production overhead cost. This is a total variance. This total variance consists of expenditure and efficiency. How do you calculate the variable production overhead expenditure variance? Basically, you have to take how much was incurred, 1230. To produce 400 units, you should have incurred per unit 1000, 1.5, right? So actually used hours were 760. So 760, if you had paid at the rate of 1.5, how much you should have incurred? 1140. So here what we are doing is actual hours taken times the budgeted rate or the standard rate 1.5. So we should have incurred this much on 760 hours, whereas we incurred it cost 1230. So therefore, there is an adverse variance of 90 expenditure variance because we plan to incur this much 1140 and we incurred 1230, right? So the other one is the efficiency variance. So here basically we have to compare the standard hours taken with actual hours taken. So standard hours, we should have taken 2 hours to produce 400 units. So therefore, that will be 800 hours. Okay. So we are going to calculate how efficiently the labor force was used. Okay. So therefore, if you take 400 units, we should have used 2 hours per unit. So basically 800 hours to produce 400 units. However, to produce 400 units, we used only 760 hours. Okay, so we have used our labor force efficiently. So we have used here our labor force efficiently. So therefore, we have a favorable efficiency variance of 40 hours. And if we had used the standard rate, it should have been $60. So that will be a favorable variance, right? So if you compare 90 adverse plus 60 favorable rate and efficiency, okay? So you will arrive at the total variance of $30 adverse variance, okay? So this is how you calculate variable production overhead cost variance. Hi everyone, welcome to the session. In this session, I'll be discussing about a question relating to standard costing and variance analysis. Okay, so let's go through the question, then we'll move on to the solution. Royal PLC, a manufacturing firm, it makes a single product, Roya, using a single raw material, rose. Standard cost relating to Roya have been calculated as follows. Okay, so you have been given the standard cost information for a single product called Roya. Standard cost schedule for Roya, direct material rose 100 kg at 500 per kg. So the total cost per unit, the direct cost per unit is 50,000, which is this product requires 100 kg at the rate of 500 per kg. Direct labor 10 hours at 800 per hour. So this unit, this product requires 10 hours at the rate of 800. So therefore per unit labor cost will be 8,000. Variable production overhead 10 hours at the rate of 200 per hour. So which is 2,000. So therefore the total standard cost will be 60,000 per unit. So this is the standard cost or the plan or the budgeted cost of Roya per unit. This is a per unit cost. The standard selling price of Roya is 90,000. And Roya PLC budget to produce 1,020 units a month. Okay, as you can see, the selling price per unit is 90,000, whereas standard cost of producing one unit is 60,000. So therefore, selling price minus standard cost will be the contribution. So this is the budgeted contribution. Okay, so which is 90,000 minus 60,000 will be 30,000 will be the budgeted contribution. Okay, so let's move on to the actual details now. During December 2020, 1,000 units of Roya were produced. How many units were produced? So this is the actual production, whereas this is the budgeted production. Relevant details of this production are as follows. Direct material for rows, information is given. 90,000 kg costing 72 million were bought and used. So the company has bought 90,000 kg and the cost was 72 million. Okay, so under direct material, now we discussed in our previous sessions, we need to calculate two basically variances, which is the price variance and the usage variance. So as far as the price is concerned, we need to compare how much used. Now, how much should have been used? We should have used. Okay, so these two we need to compare. As far as this 90,000 kg is concerned, the company has paid 72,000. So therefore, 72 million. So 72 million they have paid, used. So in order to purchase this 90,000 kg, how much they should have paid for this? Okay, which is 90,000 they bought, but our plan was to pay 500 per kg. Okay, this was our plan. So we should have paid at the rate of 500. So basically, 90,000 kg times 500 per kg will be 45 million. Okay, so therefore, we have a price variance of, there's a difference of how much? 27 million. 27 million. This is adverse or favorable. We should have paid for 45 million. However, we paid 72 million. So therefore, this is an adverse variance. So this is a price variance. How about the usage variance? So usage variance also, we have to compare two things. How much used in kg? Okay. How much we should have used in kg? Okay. So as you can see, we used 90,000 kg. Okay, to produce 1,000 units, right? So to produce 1,000 units, we used 90,000. How much we should have used? So as you can see, we plan to use per unit 100 kg. So therefore, for actual production of 1,000 times 100, how much? 100 means 100 kg per unit. So to produce 1,000 1,000 units, we should have used 100,000. So therefore, there is a 10,000 kg difference times our standard cost is how much? 50,000. So if you use this 10,000 times 50,000, so that will be how much? 5 million. Is it favorable or adverse variance? So it should be a favorable variance because we should have used 100,000 kg. However, we used 90,000 kg to produce this 1,000 units. So therefore, our variance is favorable 5 million. Is that clear? Okay. Now let's move on to the other one, direct labor. Okay. So direct labor, let me use a different color. 8,200 hours were worked during the month, and the total wages were 6.3 million. Okay. So even under direct labor, we need to calculate two types of variances. One is rate variance and efficiency variance. Okay. Even rate variance, we had to compare how much we have used or we have paid in terms of the value, the rate, and how much we should have paid. How much we should have paid. So this is what we need to compare. So as far as the rate is concerned, we have paid 6.3 million. Okay. So we paid 6.3 million. So we should have paid for 8,200 hours of work. Okay. Actual hours 8,200 we have worked. Our plan was to pay how much? 800 per hour. This was our plan. So if you take 8,200 times 800, so what will be the value? 8,200 times 800, so that will be 6,560,000. So therefore, we should have paid for this 8,200 hours 6,560,000, whereas we paid 6,300,000. Okay, so therefore it's a favorable variance of 260,000. Okay, so rate variance is favorable to 60,000 because we paid only 6.3 million, whereas we should have paid 6,560,000. So therefore the variance is 260,000. It's a favorable variance. Okay, now the efficiency. So efficiency variance also we need to calculate how much was used in terms of hours, how much we should have used. We should have used how many hours? So used hours, how much? 8,200. How many hours should I have used? We should have used how many hours as per the plan? We were planning to use 10 hours. Okay, so 10 hours for 1,000 units. So we were producing 1,000 units times 10. So that will be how much? 10,000. So 10,000 minus 8,200. So that will be 1,800. 1,800 times what was the standard rate? Standard rate was 8,000. So therefore, so in fact, this should be 800. Now let's move on to the variable production overhead. So variable production overhead, the actual cost for the month was 2,500,000. Okay, so basically variable production overhead also consists of two types of variances: expenditure variance and efficiency variance. So basically we had to compare on the expenditure variance, how much was used, how much we should have used. Okay, should have paid or used. So how much we paid? Actual cost for the month was 2.5 million. So 2.5 million was paid. So how much we should have paid? So variable production overhead, we need, our standard requirement was 10 hours at the rate of 200 per hour. So now during the period, we have used 8,200 hours, and we absorb the variable production overhead at the rate of 200. So therefore, 8,200 times 200 will be, that will be 1,640,000, I suppose. Yes, 1,640,000. So therefore, we paid 2.5 million, whereas we should have paid 1,640,000. So therefore, the difference is 860,000. Is it favorable or adverse? I think it's an adverse variance because we paid 2.5 million, whereas we should have paid 1,640,000. So therefore, we have paid more. We have used more. So therefore, it's an adverse variance. Now, efficiency variance also, we have two types in terms of hours, how much we have used and how much we should have used in terms of the number of hours. So basically, the used, so if you take the efficiency variance, used, how many hours used? 8,200. So it is given here, 8,200. How much we should have used? How much we should have used? So we are, our actual production is 1,000 units. It's given 1,000 units. To produce 1,000 units, we need how many hours? Variable production hours? 10 hours. So therefore, 1,000 units times 10 will be 10,000. So the difference is 1,800 hours. So 1,800 hours times 200, which is our standard rate, standard cost rate is 200 per hour. So therefore, that will be how much? 1,800 times 200. So 360,000. So that will be 360,000. Is it adverse or favorable? Because we used 8,200 hours. Our plan was to use 10,000. Therefore, it's good. It's a favorable variance. So expenditure variance was adverse, whereas efficiency variance, variable production efficiency variance, is a favorable variance. Okay. Now we have calculated three main variances: direct material, then direct labor, and variable production overhead. Now, in addition to that, you are given inventories of the direct material rows are valued at the standard price of 500 per kg. Okay, so that is the cost as per plan. Okay, so that is 500 per kg. Each roya was actually sold for 97,500. The actual contribution was 60,700,000. Okay, so basically you are required to calculate the following for the month of December 2020. So which is variable cost, variable production cost variance, direct labor cost variance into rate and efficiency variance, direct material cost variance into price and usage variance, variable production overhead variance analyzed into expenditure and efficiency variance. Then you have selling price variance, sales volume contribution variance, and then determine the operating statement for ROIA for the month of December 2020. So these are the requirements. However, we have calculated these main variances we calculated, okay, direct labor rate and efficiency, direct material price and usage variance, and variable production overhead expenditure and efficiency variance are also calculated. Okay, now we need to calculate basically the cost variances. Okay, so and variable production cost variance and variable production overhead variance. So this is a total production cost variance. Okay, so let's move on to the variable production cost variance. So if you take this, the variable production cost is 60,000. So variable production cost variance, so this is the total production cost. Our standard cost was how much? 60,000, right? Per unit. So we were planning to produce, our actual production was 1,000 units. So therefore we should have paid 60 million. Whereas we have paid, okay, under direct material, direct labor, and production overhead variance. So how much we have actually paid? So this you can take it from here. You are given the actual payment 72 million, 6.3 million, and 2.5 million. Okay, so direct material we paid 72 million, and direct labor we paid 6.3 million, and variable production overhead 2.5 million. So therefore, if you take 72 million, then we have 6,300,000 and 2,500,000. So if you take the total, so that will be 80,800,000. So therefore, our total production cost, variable production cost, okay, variance will be 20,800,000. So which is an adverse variance. Okay, so now basically the rate variance we have already calculated. So direct labor rate variance, we calculated 260, and efficiency variance 1,440,000. Okay, so rate variance is basically 260. It's an adverse variance. And efficiency variance also we have calculated how much? 260 plus 260 favorable, 1,440,000 favorable. Okay, so this is 1,440,000 favorable. So this is also favorable variance. Both are favorable variances. So therefore, the total labor cost variance will be how much? 260 plus 1,440,000. How much? 1,440,000 plus 260. It should be 1,700,000 favorable. Okay, so this should be the favorable variance for the cost variance. So how you can compare that? So basically, we have paid 6,300,000. That is the actual payment, whereas we should have paid 8,000 to produce 1,000 units. Okay, so basically you can calculate to produce 1,000 units, you should have paid 8,000 standard cost, which is I think 8 million. Then we have paid in total 6.3 million. Okay, so therefore the total variance will be 1.7 million favorable. So this is how we calculated. Okay, so this consists of rate variance and efficiency variance. Okay, basically those are the two variances. Now direct material cost variance into price and usage variance we calculated already. the price variance we calculated, and the usage variance also we calculated. Okay, the direct material price variance was how much? 27 million, and usage was 5 million. Okay, so this is 27 million and this is 5 million. I think this is adverse, this is favorable. So if you compare these two, that will be 22 million adverse variance. Our cost variance should be 22 million adverse variance. So how do you calculate this? You just compare how much you have paid, 72 million, against how much we should have paid for 1,000 units. To produce 1,000 units, our standard cost was 50,000. Okay, so therefore we paid 72 million. We paid 72 million, and we should have paid for 1,000 units at the rate of 50,000. Okay, so that will be 50. How much is that? 50,000 times 1,000. Okay, 50 million. Okay, so therefore this will be 22 million adverse variance. We paid 72 million. In fact, we should have paid for 50 million. So therefore adverse is 22 million. So this 22 million adverse variance consists of price and usage variance. Okay, so this is what we have calculated. Then variable production overhead variance. So already we calculated expenditure variance and efficiency variance. So expenditure variance, how much? So we calculated variable production expenditure variance 860,000 and 360,000. Okay, this is adverse and this is favorable, 860 and 360. So this is 860,000 adverse and 360,000 favorable. Okay, so therefore if you take these two, the total cost variance should be 500,000 adverse. Production overhead variance should be 500,000. So this how we can use. We have to see how much we have paid and how much we should have paid for 1,000 units. Okay, we paid 2.5 million to produce 1,000 units. 2.5 million was paid. Okay, in fact, to produce 1,000 units, we should have paid at the rate of 2,000. This was our standard cost. Okay, the total. So total standard cost, we paid 2,500,000 and we should have paid at the rate of 2,000. So that will be 2 million. So the total variance is adverse 500,000. So this consists of expenditure and efficiency variance. So basically we have calculated all cost variances. Now we have to move on to the selling price variance. So selling price variance. So as you can see, the actual units sold was 97,500, whereas our plan was to sell at 90,000. Okay, so if you take 97,500, okay, so actual selling price 97,500. Our planned selling price was 90,000. So therefore, the difference is 7,500. Our actual units produced 1,000. So therefore, 7,500,000 is our selling price variance. Actually, it's a favorable variance because our plan was to sell at 90,000. We sold it at 97,500. Okay. Now the volume variance, how much we should have used, how much we used and how much we should have sold. How much we sold and how much we should have sold. We sold 1,000 units. Our plan was to sell 1,020. So therefore, 20 is the difference times our budgeted contribution per unit is 30,000 that we calculated because our plan was to sell at 90 and our standard cost was 60. So therefore, there is a budgeted contribution of 30,000. So that difference times 30,000 will be our volume contribution variance. So that will be 600,000. That is an adverse variance because we were planning to sell 1,020, but we sold 1,000. So therefore, our sales volume contribution variance is 600,000 adverse. Okay, now we'll move on to the operating statement. So our budgeted contribution will be how much? Our budgeted contribution will be how much? We were planning to produce 1,020 and our budgeted contribution was 30,000. Okay, so we'll take it in millions here. So 1,020,000 times 30,000. So budgeted production 1,020,000 times budgeted contribution was 30 million. So therefore, that should be 30,600,000. So the figure is in thousands. Okay. Sales volume variance that we have already calculated. Sales volume contribution variance is 600,000 adverse variance. That is adverse variance. So therefore, we have to minus budgeted contribution from actual sales. So that will be 30 million. Okay. So since this is an adverse variance, we need to deduct this. Then sales price variance, we have already calculated. Price variance is favorable, 7.5 million. So we'll take that also. Selling price variance, 7,500,000 favorable. So therefore, our actual sales value will be 37,500,000. So now we'll take the cost variance into favorable and adverse. Once you adjust the cost variance, you will get the actual contribution. Okay, so we'll take the price variance. We calculated the price variance. How much? Direct material price variance is 27 million and usage variance is 5 million. Okay, so material price variance is 27 million adverse and material usage variance is 5 million. So we'll take it in thousands. Okay, 5 million. Then we'll move on to labor rate and labor efficiency. So that also we have already calculated. Labor rate variance is 260,000 and efficiency is 1,440,000. 260 and 260,000 and 1,440,000. Okay, so finally we'll take the variable overhead expenditure and efficiency variance. Expenditure is 860 and efficiency is 360. 860 adverse and 360 favorable. Okay, so once you take the total, okay, if you take the total favorable, how much? 5 million plus 260 plus 1,440,000 plus 360. So that will be 7,060,000 favorable and whereas adverse is 27 million plus 860. So that will be 27 million 860 adverse. This is total adverse, this is total favorable. So therefore, if you take the net, that will be 20 million 800 adverse. So therefore, 37 million 500 favorable, total actual sales minus cost 37 500. So that will be 16 million 700 is our actual contribution. So which is equals to the actual contribution. They have already given 16,700,000. Okay, so 16,700,000. So this is what we have reconciled in the operating statement, considering all these variances. Okay, so we have considered all the variances in this operating statement. As you can see from this, this is the operating statement. We have considered all the variances: sales volume variance, then sales price variance, then we have considered the cost variances, material price, usage, the labor rate, labor efficiency, variable overhead expenditure, and variable overhead efficiency variances. Once you adjust this, you will arrive at your actual contribution. Okay, so this is how you prepare the operating statement.